Welcome students to the series of lecture for CFA and FRM preparation, and we are into the series of lecture of currencies. And today we'll discuss about what will be the effect on the portfolio return and portfolio risk if you are investing in foreign currencies. Okay, so we are not going to like discuss about that. Hey, the return formula is the weighted average of different investment in a portfolio, and the risk formula is the WA square sigma square WB square sigma B square plus 2 into correlation between A and B, WA sigma and WB sigma B. We all know these risk and return formula. But when you invest in a foreign asset, then there are certain nuances in the calculation of return and certain nuances in the calculation of risk that you should understand. So this session is not about deriving the return and risk formula or discussing about the basic risk and return formula that we have discussed continuously in all the sessions. Yes, the return formula is going to be the weighted average of all the asset return, and the risk formula, as I described, is the square root of WA square sigma square blah 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 blah. But in this session, the focus is to understand the nuances in these formula, the tweak in these formula if you invest in the foreign currency. Okay. So first of all, let's define some terminology. Let's define some notation. Otherwise, we'll get confused in the discussions of the foreign investment. The first thing that you should understand when you invest in the home currency or the domestic currency, then you're investing in a domestic asset and you're investing in the home currency. You only think about the return of the asset in the domestic currency. Going forward, we'll not simply call it return of an asset, we'll call it as a return of the domestic currency. Okay, because this is a return in the domestic currency, the return of the domestic currency. And our objective is to convert all the returns into domestic currency. So if you get the return in the foreign currency, you convert it into domestic currency. That is the objective number one. Because you will report your return and risk in the domestic currency or in the home currency. So assume you invest in an asset that has 100 INR value at the time of investment, and at the end, it came to be 105 INR, it appreciated to 105 INR. So simply you will say that the domestic return or the return of the asset is 5%. But if you're investing in a foreign currency, in a foreign asset, if you're investing in a foreign asset, and if you try to calculate the return in the foreign currency itself, then you will denote it RFC. This is the return of the foreign currency asset. You can think it of as FCA, return of the foreign currency asset. This return is still in the foreign currency. You have to convert it into domestic currency before calculating the weighted average return of the portfolio. So for example, there is an asset which has initial value of 100 and the final value was 108. Then the total return is of 8%. This 8% still is in return of foreign currency. You have to convert it into return of the domestic currency before calculating the final answer. So what we are trying to understand how to convert the return of a foreign currency, RFC, return of the foreign currency, into RDC, return in domestic currency. That's it. Okay. So it's a very simple math. We only have to understand the notation. So at t equal to 0, an Indian investor invested in an US asset, and the asset initial value was $100. At the time of purchase, $1 was 80 INR. And at the end, after 1 year, the US asset worth increased by $20 and the final value was $120. So the return is simply what? 120 upon 100 minus 1, right? Which is what? 20%? Perfect. But the foreign currency, which was USD, appreciated by 4 INR, which is what? 4 upon 80 into 100, which is roughly around 5%. So if you want to convert it into domestic currency, this return into domestic currency, then roughly the return would be 20% plus 5%. Roughly the return would be 20% plus 5%, that is 25%, roughly. That's fine. But in finance, we have to look into the actual calculation. So actually, the RDC, the return in the domestic currency, is 1 plus the return of the foreign currency into 1 plus return of the FX. This is RFX. This return is what? Return due to foreign exchange. This is the return due to foreign currency appreciating or depreciating, right? That is RFX. The notation is RFX. And that's why we are writing 1 plus RFC into 1 plus RFX minus 1. So which is 1.20 into 1.05 minus 1. Or you can simply say that the final value is 120. Convert it into what? INR divided by the initial investment, which was of 100 into 80. This and this is identical. At the end, you will get the value which is 26%. This is the accurate value to calculate the RDC, the return in the domestic currency, if there is an investment in the foreign currency. Okay. So let's do one question. If you have understood that how to calculate the return in domestic currency, if you have given return in the foreign currency and the return of FX, which is the return due to the appreciation and the depreciation of the foreign currency. Okay. So there is a USD investor. So what is the domestic currency? USD invested in euro. What is euro? Foreign currency. The value of portfolio in euro increases by 15%. So is it RDC or RFC? This is RFC, return of the foreign currency asset in the foreign currency. The euro dollar exchange rate increases from 1 USD upon euro to 1.05 USD upon euro. Now, this is important, and this is the nuances that I want to tell. Currently, the USD is in numerator, the domestic currency is in numerator, and the foreign currency is in denominator. So, if you calculate RFX is equal to 5%, you can directly use it. You can directly use it because it is telling you directly that euro has appreciated by 5%. That's perfect. So RFX is 5%. That's perfect. But it is only true. It is only true if the quotation is that the foreign currency is in base currency and the domestic currency is in the price currency. So RFC given was 15%, RFX was 5%. You can directly use the formula RFC 1 plus RFX minus 1, which is 1.15, 1.05 minus 1, and you will get the final RDC, the return in the domestic currency. Let's do the calculation. But what I'm trying to highlight with this calculation is that you can only do this. You can only do this if the foreign currency is in the base currency. If the foreign currency is not in the base currency, then this calculation would be completely wrong. Okay. What I'm trying to highlight now, the nuance, is that the appreciation in one currency, which is 5% currently, is not equal to depreciation in other currency. No, never. So if you are saying that in this example, euro has appreciated by 5%, that's fine, that's correct. But if you're saying USD has depreciated by 5%, that is incorrect. And for that, I'll try to help you understand that appreciation is not equal to depreciation. You can only use this formula, this RDC formula, if the foreign currency is in the base currency. And to highlight that, I want to tell you, I want to explain you that appreciation of one currency is not equal to the depreciation of other currency. Okay, so assume we are talking about INR and USD, and one USD is trading at 80 currently at the time of investment, and after 1 year, one USD is equal to 85 INR. So definitely there is an appreciation. And we are talking from the perspective of an investor from India. So the foreign currency is what? USD, and foreign currency is in denominator. So if you do 85 minus 80 upon 80, which is 5 upon 80, then the value will come around 6.25%. I can say, yes, this is an appreciation of USD. This is the appreciation of USD because one USD has increased from 80 to 85. That's fine. But I cannot call this as the depreciation of INA because if I say at the time of investment, if I flip it and I say that a person is investing from USD and the foreign currency is in INR, then please understand the depreciation is not 6.25% because one INR value at the initiation is 1 upon 80. Let's write the value. So 1 upon 80 is 0.0125. This is the value of 1 INR. Now 1 INR is 1 upon 85. And this came to 0.0117647, so and so forth. This is the new value of 1 INR in the terms of USD. Okay. And we have to find out whether the INR has depreciated or appreciated. We can see that it has depreciated, but what is the value? So this is the final value. So final value minus initial value divided by the initial value. So let's do it. Minus 0.0125 divided by 0.0125. Okay. And the value came to 5.88% approximately. The depreciation in INR for the same change in FX rate is different from the appreciation in USD. Because when you're calculating, here the base was 80, and here in the calculation of appreciation or depreciation of INR, the base was 0.0125. And therefore, it cannot be identical. Okay. If you haven't understood this till now, that why this is important, let's do one question and try to understand that what would be the effect if you're investing in two different foreign currency with a weight of 75% and 25%. And if you have to calculate the final return of the portfolio in the domestic currency, which is EUR, then how would you calculate it? Okay. So let's look into the formula. The final formula to calculate the return in the domestic currency of the portfolio is the weighted average of returns of different investment. That is the final formula. Okay. So the return of a portfolio is always weighted average of all the returns. This formula is valid if you're investing in domestic asset. But if you're not investing in domestic asset, but if you're investing in the foreign assets, then the formula of the portfolio is weight given to the first asset, the foreign asset, and the return of the foreign asset in what? In the domestic currency term, not in foreign currency, right? And we just saw that the return in the domestic currency is equal to 1 plus RFC, 1 plus RFX minus 1. And I can use it directly only if the nuance that we discuss, nitties and gritties that we have discussed is, I can only use it if the foreign currency is given in the quotation as a base currency. Otherwise, I cannot use the formula because the appreciation and depreciation would be different. Okay. Plus, weight of the second currency or weight of the second currency asset in the portfolio, return of the second currency in the terms of domestic currency, not the foreign currency. So again, I have to apply the formula. Okay. So do we have weights given? Yes, I have the weight that is 75% and 25%. Perfect. So, so let's use the weight. So weight is given. If I invest in USD, the weight is 75% of the portfolio. Plus the weight in GBP is 0.25. But I don't have RDC, I have RFC. I have RFC for both the investment. I cannot use 5% and 10% directly. I have to convert them into the domestic currency. And for that, I need what was the appreciation or depreciation from the time of the beginning of the investment and at the time when you're calculating the return, that is the end state. Okay. So USD UR is the quotation given. Can I use this quotation directly? Is foreign currency is in the base currency? No, I cannot use this quotation. Can I use this quotation? GBP is the foreign currency which is in the base currency. Can I use this quotation to find out RFX? Because RFC is given. The foreign asset has increased in value by 10%. So RFC for GBP is 10%. RFX is 1.25 upon 1.2. I can directly use it. So which is giving me the value of 25 divided by 1.2. that is 4.166%. So basically, if I have to convert this into RDC, that is 1.10 plus 1.04167 minus 1. So the final value would be 14.58, 14.583%. 14.583%. I can use this 14.583% for GBP. But can I use this quotation directly? I cannot use this quotation directly. I cannot do 1.4 upon 1.3 because this will not tell me the USD appreciation or USD depreciation. We are interested in whether the foreign currency has appreciated or depreciated. So for that, we have to convert this quotation in the terms of USD, as in USD in the denominator. So let's take the reciprocal, which is 1.13, and this is 1.14. 1 upon 1.13 is equal to, this is giving me a value of 0.7692. Take the value till 4 decimal places, and this will give me the value of 1 upon 1.4, that is 0.71428. Make it 3. So this is in the quotation of EUR upon USD. So it is saying 1 USD was earlier had a value of 0.7692. Now it has a value of 7143. Has it appreciated or depreciated? Depreciated, we all know. Let's find out the value. So it would be 7143 divided by 0.7692. And this has depreciated somewhere around 7.2%. Okay. So let's find the RDC for USD. So if I do 0.7143 divided by 0.7692, and then if I do minus 1, then it has depreciated. USD has depreciated by negative 7.137285. It has depreciated more than the increase in the value of the asset. So actually the net return would be somewhere around negative 2.13%. Okay, let's do the calculation. So the formula to calculate RDC is 1 plus RFC, which is 5%, 1 plus RFX, which is negative 7.137285% minus 1. Okay, into 1.05 minus 1. The net return is negative 2.45. Negative 2.45. And this is the return I can use in the calculation. If you would have used this quotation of 1.3 and 1.4 directly, first of all, this will give you incorrect appreciation of USD. The second, even if you say that USD has depreciated and I can simply use 1.4 upon 1.3 and find out the value, still you cannot use the value, because if you do 1.4 upon 1.3, this will give you a value of 7.69% as a depreciation in USD. But actual depreciation in USD, but the actual depreciation in USD is not 7.69, it is 7.137285. So it is very important. The nuance that I'm trying to highlight, that every time you do the calculation, the foreign currency should be in the base currency. So this was the discussion around that how can you calculate the return of the portfolio. Now let's deep dive into the risk of the portfolio. If you're investing in the multiple asset, the risk of the portfolio formula is not going to change. I'm just trying to highlight. I'm just trying to put down the light on some of the nuances that you will miss. Okay. So first of all, the risk of the portfolio is equal to WA square, sigma A square, WB square, sigma B square, WC square, sigma C square, and then the correlation term between A and B and C, A and C, which I have written here, right? These are the correlation terms. So whenever you try to find out the risk of the portfolio, you need three things. You need three things. The weight of each asset, WA, 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 risk of each asset, sigma A, sigma A, sigma A, and the correlation between each asset, the correlation between A and B, the correlation between A and C. right? You need these three things. When you invest in currency, it gets slightly tricky because if you invest in one foreign asset, actually you're investing in two assets. One asset, which could be, say, Meta, Facebook, and one asset, which is the foreign currency. So actually, you're exposing yourself to two risks rather than one risk. So when you invest in a foreign asset, you're exposing yourself to two risks. One is the risk of the foreign asset, and another is the risk of the foreign exchange or the risk of the foreign currency and the risk of the volatility of the FX rates, USD versus INR, USD versus EUR. The volatility between the exchange rate, the volatility due to exchange rate. So how to deal with it? To understand that, let's assume you're investing in one foreign asset, 100% weight given to one foreign asset. Okay. So I'm writing W1 square, sigma 1 square, W2 square, sigma 2 square, plus 2 into correlation between 1 and 2, W1, W2, sigma 1, and sigma 2. This is unnecessary. And sigma 1, sigma 2. Now understand what 1 represent. 1 represent the standard deviation, or 1 represent the investment in the foreign asset. 2 represent the return in the foreign exchange or the weight given to the foreign exchange as an asset. And sigma 1 represent the volatility in the return of the foreign asset, the volatility of Facebook return, the volatility of Microsoft return. If you are in India and investing in USD asset, sigma 2 is the risk or the volatility of the foreign exchange, USD versus INR. If you're in India and investing in USD asset, so you are interested in the volatility of USD and INR, but you're also interested in the correlation between the foreign asset and the FX rate. It could be possible there is a positive relationship. So whenever the Meta stock increases, the USD also appreciate. And whenever the Meta stock fall, the USD also depreciate. This is a positive correlation. And if there is a positive correlation, then the risk in your portfolio is very high. How come? Let's understand with negative correlation. In negative correlation, if the Meta stock increases, the USD is falling, and if the USD increases, Meta falls. So if somehow Meta falls, you know there is a negative correlation, the USD will appreciate and it will hedge the risk of Meta falling. Second scenario is that if the USD depreciate, you know that the Meta will increase and it will hedge the risk of USD falling. So lower the correlation, lower the risk, higher the correlation, higher the risk. Between what? Between two different assets? No, not two different assets. Between the investment in the foreign asset and the FX rate, the correlation between the two. So even if you have 100% investment in one USD stock, just one USD stock, your formula is not WA square sigma square only. You have the risk of the foreign currency asset, you have the risk of the FX, and the correlation terms between the two. Okay. Now, if you have two foreign asset, say USD and GBP, sitting in India and you're investing in USD and GBP, what will happen? Actually, you're taking risk of four assets. You're taking risk of four asset. First risk. The first risk is because of the asset in USD. The second risk is because of the asset in GBP. The third risk is because of the FX of USD, AFX. The fourth risk is because of the FX of GBP versus INR. So there would be four assets. But how many correlation terms? How many correlation terms? Because of four assets, there would be six correlation terms. First correlation between USD and GBP. The second is between USD asset and USD FX. The third is USD asset and GBP versus INR FX. Right? So three because of this, this, and this. Then the correlation between the two. Right? Then the correlation between this. So if you keep on writing, there would be in total six correlation terms. And if you're able to write this six correlation term, then you understood that there are, if you're investing, you understood that when you're investing in a foreign asset, one single foreign asset, you're exposing to two different risks. And you have to cater not only to these two different risks, but the correlation between this with others and this with others. So in total, if there are if there are two foreign investment, two foreign investment, then the formula to find out the number of correlation term is this: 2n bracket open 2n minus 1 upon 2. So if you put down 2 here, so 2 into 2, 4 minus 1 upon 2, that is 4 into 3, that is 12 upon 2, that is 6 term. Okay, you can simply do n into n minus 1 upon 2, but you will miss that if you're investing in one foreign asset, you're exposing yourself to two different risks. Okay, you can directly write n into n minus 1 upon 2, but you need to be cognizant that when you're writing n here, you're respecting that if you're investing in two assets, you're actually investing in four assets. Okay, so whichever formula you think is correct, but you need to be very cognizant, you need to be very cautious that whether you are saying two different investment in two different currency, or you are saying if you are investing in one currency, it means it is two asset. One the asset in the foreign country and another is the exchange rate as an asset. Okay. With that, you have understood the nuances in the calculation of return and risk of the currency. With that, I'll pause here. Thank you. Have a nice day.